Welcome back to Investing Talk Podcast. Today we're looking at KE Holdings, ticker symbol BEKE, a major player in the Chinese real estate market. It's a bit of a best bag out there in the market right now. And real estate, especially office spaces, is facing some serious challenges. But KE Holdings focuses on residential real estate. Could that make them a good bet in this environment?
That's a great question, and it's definitely something to consider. But before we jump in, it's important to understand that investing in Chinese companies listed on U.S. exchanges has its own unique set of risks, particularly when they use a structure called a variable interest entity, or VIE. KE Holdings operates under this structure, so understanding how it works and the potential implications for you as an investor is crucial.
Okay, so VIEs are a key piece of this puzzle. But first, let's look at how KE Holdings has been performing recently. The stock's up today, trading at $20.50 a share, which is a gain of 0.54%. It's currently trading above both its 50-day and 200-day moving averages. And we're seeing higher than average trading volume. Some people might be confused by these terms like moving averages. Can you break down why those are important indicators and what this recent activity suggests about investor sentiment towards KE Holdings?
Absolutely. Think of moving averages as trend lines that smooth out the day-to-day price fluctuations, helping you see the bigger picture. The 50-day moving average gives you a short-term view of the trend, while the 200-day offers a longer-term perspective. When a stock is trading above both, like KE Holdings is now, it generally suggests positive momentum and potential for further growth. The increased trading volume adds fuel to that fire, indicating strong interest from investors.
So we're seeing positive signals from the market. What's driving this upward trend? Especially when the overall market seems a bit shaky. Is it just the focus on residential real estate?
It's definitely a factor. But there's more to the story. We've seen increased institutional ownership recently. With firms like 91 UK buying up more shares, that often signals confidence from big players who have done their homework. Also, KE Holdings recently released strong Q2 2024 results, showing increased revenues and net income, which always gets investors excited. Plus, they've expanded their share repurchase program, signaling that they believe the stock is undervalued, and they're willing to put their money where their mouth is.
That's interesting. Almost like they're doubling down on themselves?
Exactly, and it's not just the company showing confidence. Major analysts like Bank of America and Barclays have recently upgraded KE Holdings to a buy rating and raised their price targets. That's a pretty significant vote of confidence from these influential firms. All of this combined has contributed to a $3.1 billion increase in market cap in just 1 week. And the stock's one-year return is a whopping 48%.
Wow, that's impressive. It sounds like there's a lot to be optimistic about. But you mentioned earlier that investing in Chinese companies like KE Holdings, especially those with VIE structures, comes with specific risks. Can you unpack that for us? What exactly is a VIE and why should investors be concerned?
It's a bit complicated, but essentially, a VIE is a legal structure that allows Chinese companies to list on U.S. exchanges while still complying with Chinese regulations that restrict foreign ownership in certain industries. It's a kind of workaround.
So where's the catch? There's always a catch, right?
The catch is that the enforceability of these VIE contracts in Chinese courts is still somewhat uncertain. It adds a layer of legal and regulatory risk because you're essentially relying on a structure that hasn't been fully tested. And since July 2021, the SEC has been scrutinizing Chinese companies listed on U.S. exchanges more closely, adding to the uncertainty. It's like building a house on a foundation. That might shift a little, you hope it holds up, but there's always that nagging doubt in the back of your mind.
Okay, so VIE risk is something to keep in mind. But focusing back on KE Holdings for a moment, what should investors be watching for to make a more informed decision about whether this stock is right for them?
Well, their upcoming earnings report will be a major event. Earnings reports always generate buzz and can cause significant price swings. But it's especially true in this current market environment, which is pretty sensitive to any signs of weakness. How KE Holdings performs in the next quarter could give us a clear picture of their resilience in this uncertain real estate climate.
So keep an eye on those earnings numbers. What else should investors be paying attention to?
Don't forget about the bigger geopolitical picture. Any changes in U.S.-China relations can have a ripple effect on Chinese companies listed on U.S. exchanges. Increased tensions or new regulations could definitely impact KE Holdings.
So we've got these market forces and geopolitical factors to consider. But let's not forget about the company itself. What's KE Holdings' long-term strategy? Are they just riding the real estate wave? Or are they actively trying to position themselves for future growth?
They're definitely not sitting still. One interesting thing they've been doing is focusing on acquiring smaller niche players in the real estate market, for example. They recently bought a company that specializes in property management for senior living facilities.
That's intriguing. So they're not just going after the biggest companies. Why would they target these smaller players?
It seems like a smart strategy to diversify their offerings and tap into specific markets with growth potential. Think about it. China has an aging population, and the demand for senior living facilities is only going to increase. KE Holdings is positioning themselves to capitalize on that trend.
So it's about finding those pockets of opportunity and specializing.
Exactly. And it's not just about acquisitions, they're also embracing technology in a big way. They've been investing heavily in their online platform, developing tools for virtual tours, property valuations, and even mortgage applications.
So they're trying to become a one-stop shop for all things real estate, from searching for properties to financing them. But what about the competition? The Chinese real estate market's pretty crowded, right? How does KE Holdings stack up against other major players like eHouse and 555J?
It's a tough market, no doubt, but KE Holdings has managed to differentiate themselves by focusing on building a strong brand reputation. They've really prioritized customer service and transparency, which is crucial in a market that's sometimes seen as opaque and even shady.
So they're trying to build trust, which is especially important when dealing with something as significant as real estate.
Absolutely, and they're going to beyond just talk. They've invested heavily in training their agents to ensure they are knowledgeable, professional, and truly focused on helping their clients. It's a combination of strong branding and a genuine commitment to service that sets them apart.
Okay, so we've got this company with strong financials, strategic acquisitions, a focus on technology, and a good reputation. Sounds pretty positive. But let's go back to those VIE risks for a moment. How much should those really factor into an investor's decision? Are we talking about a minor inconvenience or a potential deal breaker?
That's the million-dollar question, isn't it? The VIE structure is complex, and there's no easy answer. On the one hand, you have the potential for regulatory hurdles and legal challenges that could negatively impact the stock price. On the other hand, you have a company that's performing well and showing all the right signs of growth.
So how do you weigh those two sides?
Every investment carries some level of risk. The key is to understand those risks and decide if the potential rewards outweigh them. With KE Holdings, you're essentially betting on their ability to navigate the complexities of the VIE structure and the Chinese regulatory environment. You're also betting on the continued growth of the Chinese residential real estate market.
And that market has been a bit of a roller coaster in recent years, hasn't it? There have been concerns about a potential housing bubble in China. How serious is that threat? And how might it impact KE Holdings, even with their focus on residential real estate?
It's a valid concern. Rapid price increases in some major Chinese cities have definitely raised questions about affordability and potential oversupply. The Chinese government has implemented measures to try and cool down the market, but it's too early to say how effective those will be in the long run.
So there's a lot of uncertainty. Does that mean KE Holdings is a risky bet?
It depends on your perspective and your risk tolerance. KE Holdings' focus on residential real estate could actually play to their advantage if the office market really takes a hit. They might be somewhat insulated from the worst of the downturn in that scenario. However, it's important to remember that a weakening overall economy could still impact demand for residential properties as well. It's all interconnected.
Right, you can't completely escape the broader economic forces at play.
Exactly. The Chinese real estate market is influenced by a whole web of factors: government policies, economic growth, demographics, even cultural preferences.
Okay, so we've got this multifaceted puzzle with a lot of moving pieces. We've got KE Holdings, a company with a lot of potential but also some inherent risks. We've got a volatile market, a complex regulatory environment, and a Chinese real estate sector that's facing some headwinds. How do we make sense of all this? What are some key takeaways for investors?
That's what we're here to figure out. Let's shift gears a bit and explore some potential scenarios and outcomes.
All right, so let's play a little game of what if. What if the Chinese real estate market takes a serious downturn? How do you think that would affect KE Holdings, given their focus on the residential side?
Well, if we look at the bigger picture, it really depends on how bad the downturn is and how long it lasts. A mild slowdown might actually be good for KE Holdings. Think about it. When the market cools down, people tend to rely more on experienced agents to help them navigate the complexities. That could drive more business to KE Holdings and help them increase their market share.
So almost a reverse advantage.
Exactly. But a major crash would be a different story. Even with their focus on residential real estate, they wouldn't be immune to the broader economic impact. Falling property values, fewer transactions, and more defaults would definitely hurt their profits.
That makes sense. It's all about evaluating the level of risk. Now, what if the opposite happens? What if the Chinese government steps in with stimulus measures and the real estate market heats up again?
In that scenario, KE Holdings would be in a prime position to benefit. Their established platform, strong brand, and large network of agents would give them a big edge. They could see a surge in transactions, higher revenues, and potentially even better profit margins.
So they have the potential to do well in both a cooling market and a heating market.
To a certain extent, yes, but it's important to remember that these are just hypothetical scenarios. The reality is likely to be much more complex.
Which is why diversification is so important, right? Don't put all your eggs in one basket.
Absolutely. Now, here's where things get really interesting. What if the SEC decides to take a tougher stance on VIE structures? That's a real wild card. That could have a huge impact on KE Holdings and other Chinese companies listed in the U.S.
So that legal and regulatory risk we talked about earlier could actually become a major problem.
It's definitely a possibility, and investors need to be aware of that. Increased scrutiny, new regulations, or even delisting could seriously disrupt KE Holdings operations and send their stock price tumbling. This brings up an important question for our listeners. How comfortable are you with that level of uncertainty?
That's a great question for investors to consider. So we've explored these whatever scenarios for the real estate market and potential regulatory changes. But let's not forget about the company itself. KE Holdings has been actively expanding their services and investing in technology. How could those strategic moves affect their future?
That's where the company's fundamentals will come into play, by expanding into areas like property management, rentals, and financial services. KE Holdings is creating multiple sources of revenue and reducing their dependence on just buying and selling. And their investments in technology are all about making things more efficient, improving the customer experience, and ultimately staying ahead of the competition.
So they're not just reacting to market trends, they're shaping their own path forward.
Exactly. And that proactive approach is something investors should find encouraging. It shows adaptability, strategic thinking, and a commitment to long-term growth.
All right, so to wrap things up, we've looked at KE Holdings from every angle. They have a lot going for them. Strong financials, growing market share, strategic acquisitions, and a focus on technology. But they also face some challenges: a volatile real estate market, potential regulatory hurdles, and the inherent risks of a VIE structure.
Investing in KE Holdings isn't a simple decision. It requires carefully considering the potential rewards and the risks involved.
It's about doing your research, weighing the pros and cons, and making a decision that aligns with your personal investment goals and your risk tolerance. So to sum it all up, KE Holdings, that's BEKE, is a company with a lot of potential, but it's not without its risks.
If you're considering investing in KE Holdings, make sure you understand the company, their market, and the unique risks associated with Chinese companies listed in the U.S.
We hope this deep dive into KE Holdings has given you valuable insights and maybe sparked some interesting thoughts. Remember, knowledge is power when it comes to investing. The more you know, the better equipped you'll be to make smart decisions. We always appreciate you tuning in to Investing Talk Podcast. If you enjoyed this episode, please subscribe, share it with your friends, and let us know your thoughts in the comments. We'll see you next time for another informative discussion about navigating the world of investing.